Today, let's dive into one of the most iconic blue-chip stocks on the Hong Kong Stock Exchange, HSBC Holdings. This stock isn't just a staple in the Hang Seng Index, it's also a bellwether for global financial health, especially when it comes to east-west capital flows. If you're interested in banking, dividends, and long-term global exposure, then HSBC is a stock you need to keep your eyes on. But as always, let's break it down step by step. HSBC is one of the largest banking and financial services institutions in the world. Its global footprint spans over 60 countries. But what's unique is how much of its revenue still comes from Asia, particularly Hong Kong and mainland China. Despite being headquartered in London, HSBC is deeply embedded in the fabric of Hong Kong's financial system, and that's why its listing here is so important. The bank serves millions of customers through a network of retail, commercial, and investment banking services. That global reach, while an asset, also brings exposure to international risks, like interest rate cycles, regulatory changes, and geopolitical tensions. Now, let's talk numbers. As of 2025, HSBC has been benefiting from the rising interest rate environment, especially in the US and UK, which has boosted its net interest income. In the first half of 2025, the bank reported solid earnings growth, with net profit climbing thanks to higher interest margins. But here's the catch. While profits are up, costs are also creeping higher. Inflationary pressures, wage increases, and compliance costs continue to eat into margins. And when you combine that with HSBC's continued investments in digital banking and restructuring efforts in underperforming markets, it's a constant balancing act. One of the biggest points in HSBC's favor has always been its dividend yield. Investors love this stock for its strong and consistent dividends, which are among the highest in the Hang Seng Index. In recent years, the bank has reinstated and even increased its payouts, making it very attractive for income-focused investors. But keep in mind, dividend sustainability is tied to earnings, and any global slowdown or credit losses, especially from China's property sector, could force the bank to tighten the reins again. Speaking of China, let's talk risk. HSBC is uniquely exposed to both Western economies and China's slowing growth. Its position is further complicated by ongoing geopolitical tensions between China and the West. As a result, the stock tends to react strongly to any news out of Beijing, Washington, or London. Its role in navigating this complex environment is both an opportunity and a risk. Investors need to be ready for volatility. The situation in the Chinese property market, especially with companies like Evergrande and Country Garden, continues to put pressure on the financial system, and any defaults or contagion effects could eventually flow into HSBC's loan book. From a valuation perspective, HSBC is currently trading at a relatively attractive price-to-book ratio compared to its historical average and to other global banks. That's partly because the market is still cautious about global growth and financial stability. However, if the global economy achieves a soft landing and interest rates remain elevated without spiking defaults, HSBC could be in a strong position to outperform. Its cost-cutting programs, digital banking transformation, and regional pivot to Asia all point to long-term growth potential.